All right, we're talking about Electrosteel castings this morning. They've had a pretty good quarter. Q4 has seen revenues up 7%, but look at their EBITDA and EBITDA margins. EBITDA up 61.5%, margins at 15.5% versus 10.3%, and net profit up 153%. 227 crores versus 89.5 crores. What's the story behind the numbers? Uddhav Kejriwal, whole-time director at Electrosteel Castings, with us today. Mr. Kejriwal, good morning. Thank you for speaking with us here at NDTV Profit. Great to have you on. Can you hear
Good
me?
morning.
Yeah.
Thank you.
All right,
Yes,
there you
very
are.
well.
All right, let's start talking about this quarter and what has worked for you in Q4, despite the fact that you've seen major renovation and repair work. So your Kharda plant was out of action for a bit. But nevertheless, you've seen quite a strong bottom line here.
Yeah, so during the year, we have sold about 7.5 lakh tons of DI pipes, vis-a-vis 7 lakh 10,000 what we sold last year. So we have registered a volume growth of about 5%. The pricing continues to remain strong, thanks from the market excitement. And we have reported a consolidated total income of 7,580 crores, vis-a-vis 7,360 compared to the previous year. So that is a growth of about 3%. Now, what has worked? So coming to what has worked, now our EBITDA margin has grown from 11% of the previous year to about 17% this year. Now, the way we look at it, the main factors that have contributed to this, first of all, would be that we have a strong order book this year. Secondly, we have got decent support from the manner in which the commodity prices have behaved, particularly coking coal, which happens to be the largest contributor to our cost and is an imported raw material, and also from the operational efficiencies. So these would be the three factors I would put down for what has worked for us as far as our EBITDA margins are concerned. And post that, when we're going from EBITDA to the PAT, definitely the reduction in interest cost from 272 crores to 202 crores, that is a 70 crore reduction this year, has definitely made the PAT look nicer.
You've got a pretty ambitious guidance, and I think the market will be getting excited about that. You're expecting margins to improve further to the range of 17 to 18%, Uddhav. Is that correct?
So this year has been an interesting year in many respects. And yeah, we are working hard to do better than what we are doing. But having said that, I think we would like to believe that we would continue to sustain 16 to 17%, because there are too many variables at play in the business that we are. So yes, I think obviously the efforts will always be there to do better on part of the entire team. But yeah, I think for saying purpose, I think I should say that we will be working to sustain 16 to 17%.
Also, what is capacity utilization currently at? And you've got, you want to walk us through what your expansion plans are in FY25? Where do things stand? And also, how would you be funding this? Because I do notice that you've got a long-term debt of about 400 odd crores, capital requirement, I'm guessing, working capital is about 1,800 odd crores, and you're sitting on healthy cash too. So any plans to retire debt, or is there more expansion on the cards?
I'll just take you through this piece. We have concluded this financial year with about 7.5 lakh tons of pipe. By the end of 24-25, we should be having a production capacity of 900,000 tons. And by the end of 25-26, we'll be with a production capacity of 1 million tons of ductile iron pipe. So this is on the production capacity piece. Now, the capacity utilization part. So keeping in mind the current market scenario, we would have been at 100% capacity utilization even this year, had it not been for our maintenance shutdown that had to be taken up this year. But going forward, from this financial year onwards, we don't see any reason why we will not be utilizing 100% of our capacity. And we will be pretty much selling whatever we are producing the way things look right now. So that is on that. Now, coming to the debt part, which you wanted a little bit of elaboration upon, you are very close to the figures that we have a long-term debt of about 500 crores and a short-term of about 1,500 crores. So our total debt stands at about 2,000 crores as of now. And we have a debt equity of about 0.31 as of now. So yeah, we are looking at funding this entire increase in manufacturing capacity by internal accruals, no doubt. That is the first part. And the second part is that we are hopeful of going ahead and completing our scheduled debt repayments as per plan as well.
Mr. Kejriwal, I just wanted to know about the sustainability of your EBITDA margins. You've had a sharp increase and you put it down to volume growth. I want to understand if 15.5% becomes the new normal. Do you see that sustaining into FY25?
So maybe just a corrigendum. I mentioned that the EBITDA margin growth is a combination of a couple of factors. I did mention that I'm getting support from a strong order book. Also, the commodity prices, especially in the international market, for my coking coal, and also the operational efficiencies. So now going forward, we have a decent order book in hand. We are sitting on an order book of around 9 to 10 months even today. So the order book factor does not seem to be a matter of concern for this financial year, definitely. And also on the raw material prices, we are very much in the market, very close, with a very close tab on the developments in the international market. And we would like to believe that we do take conscientious calls depending upon the way we see market behavior. And I think definitely for the first quarter, we are well poised with our costs. So keeping all that in mind, I had mentioned that I will be able to sustain an EBITDA margin of 16 to 17%.
All right. Thank you so much, Mr. Kejriwal, for joining us today. A strong quarter for Electrosteel castings. And that was the management talking about how they see those margins also sustaining. In fact, they've